Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, welcome to another great episode of We Build Great Apartment Communities, the only place where you come to learn how to take apartment buildings and turn them into amazing communities. I have Aaron Fragnito here as a guest. Very excited to have him on. I'm your host, John Brackett. We are going to get into another great show here, another great conversation around not only multifamily real estate, but how multifamily real estate is a great complement, or can be a great complement, to short-term rentals. And, you know, Aaron and his team, they have been in that space creating that complement now for quite some time. So I'm very curious, as I know you all are, to learn a little bit about what makes that work and the synergies that can be created when you own residential product, right, with a different focus. So with that being said, Aaron, welcome to the show, bud.
Thank you, John. Glad to be here. I love your background. It's pretty cool, simple, straight to the point.
I appreciate that. Hey, man, so tell us, share with us your background. Share with us your background, your story, how you got into this business, and, a little bit about your company.
Sure. So I actually, started with the landscaping business, the painting business through college and high school, and majored in entrepreneurship, and always knew I had a passion for owning my own business, but wasn't really sure of the asset class. And I read Rich Dad, Poor Dad about 10, 11 years ago. And like many people, it completely educated me on how the tax system works, how wealth works. Obviously, I wanted to create wealth and passive income. And I wanted to also create jobs and businesses. And real estate, after reading Rich Dad, Poor Dad, I realized I really had a passion for it. And as the book says, you just buy some real estate and bada bing, bada boom, you're rich. Of course, it's a lot harder than that. It took a good 10, 12 years. And I teamed up with great people. I teamed up with not so great people, found a good partner in Seth Martinez. And together, Seth and I have built a nice portfolio, a management company. We've done the apartment building repositioning for many years. We've been doing the short-term rentals for a few years now as well with Airbnb, very cool technology. And we've built a nice group, a nice investor group, about 50 investors that reinvest over time, and a nice system here. But boy, oh boy, it took many years to learn how to do this stuff,
Yeah, of course. You mean it doesn't just fall from the heavens, huh?
No, the gurus might tell you, you can buy the course and boom, you're a millionaire. But I got to say, my friend, there's no course like real life transactions, doing deals, making money, losing money. That's how you learn this business.
Yeah, 100%. I appreciate the transparency. So, one of the things that stood out to me was the road less traveled, right? Your commentary around the road less traveled. And that is just gaining wisdom or knowledge through action and just being in the trenches. Probably, perhaps the best way to actually learn. And of course, if you complement that with some specific information, helpful too, right? Or education. I think that's kind of a dated terminology, but I like specific information. So with that being said, talk to us a little bit about maybe your greatest lesson that you've learned up to this point. And of course, you're still learning, and I get that. That has allowed you to grow, a little bit quicker or more profitably, or that has added a lot more value to the way that you do business. What is the one thing that stands out to you?
Well, one thing, I guess the biggest lesson I've learned is know people who you're hiring, know their limitations better than they do. If you're hiring contractors and you're hiring a contractor that helps you fix a leaky pipe, and then you're going to develop a piece of real estate from the ground up. And he says, well, I can build from the ground up. I've done framing. I read a book on plumbing and electrician. I'll build your house. No other contractors and other service providers, partners, anyone you're working with, investors, right? Their limitations on how much they can invest. They'll overpromise as well, and that can screw you up on an acquisition. But know the limitations of the people you're working with, perhaps better than they can. And it's hard if you don't know someone. Obviously, the first time you work with someone, you're not going to know that really. Right. But references are helpful. But the only place I've really lost money in this business is a few and far between, but in construction, heavy construction, where we are taking an older property and renovating and making it new again. And the contractors would overpromise and underdeliver and say, I can gut this whole house and renovate it for 180 grand. And you're thinking, there's no way you can do this for 180 grand. I'm running the numbers in my head. The materials alone are going to be almost that, and if it sounds too good to be true, it probably is. But that's the only place I really struggled in this business through the years, is hiring the wrong contractors that overpromised and underdelivered. And I knew their limitations. I knew they weren't capable of doing what we discussed and agreed to for that price. And when it came out 2 or 3 times what they told me it would, and the investment was a loss, you learn then to work with the right people and start them small and then build up from there.
Okay, and so how did you fix that challenge? What did you do to course correct?
Well, I fired the contractor. Firstly, I got rid of the contractor that overpromised and underdelivered. You got to pay them to go away too, because they're doing work, So they're saying, well, I just gutted your whole house for you. You owe me for the gut job, and great. That's great. So, then I hired a new contractor. Had our challenges there as well. He installed flooring in the basement and left the door open for a few days, and water got into the property, and he had to redo all the flooring again. So I probably didn't hire the best genius. And this was years ago, back in 2014, 2013, really just learning through flips and things like that. But it kind of went Murphy's Law, what can go wrong will go wrong. The property ended up selling for less than we thought it would. Just the home inspection was a disaster because the new contractor we hired wasn't so great after all. But we got the job done, and we made good to our investors. So our investors didn't lose a single dollar. And that's the important thing too, when you're working with operators and they say, listen, like in baseball, not every it's going to be a home run. You have your wins, you have your losses. Hopefully your wins far outweigh your losses. And they do here at People's Capital Group. But, basically at the end of the day, we made good to our investors. They made a nice double-digit return on their investment. And it ended up being a learning situation for us and a profitable situation for our investors. So at the end of the day, everything worked out,
Yeah, no, that's great. And so how do you start vetting out your contractors now based on your experiences, right? Up to this point, what have you changed in your process to ensure that doesn't happen again?
So we structure our acquisitions and our developments completely different now. Our contractors we work with, if it's like I'm getting a deck stain or something, yeah, I'll hire a contractor. But if we're doing ground up development right now, and the way we structure is that our contractors get ownership in the property, and I wouldn't just do this with any contractor you meet, at Home Depot, but once you have a relationship with a good contractor, a builder, we're doing ground up development right now. We have the builder build at cost, and there is a lot of trust with that as well. But once you kind of know your numbers, it's pretty good to you can enforce that. So the builder builds at cost, but we'll give 30 to 35% of ownership, depending on the size of the project, to the builder, and the builder gets paid through equity. So the job has to get done in the right time period. The quality of the work has to be there. We have to get it sold or leased or refinanced or whatever the exit strategy is. That has to happen. And if the builder didn't do his job right, that's not going to happen. He's not going to get paid. So our builders build at cost now. We don't pay a single dollar for any of their service or anything like that. It's just the cost of material, the cost of labor, and then all their profit comes at the end when we exit the investment along with the contractor. But you need to have a good relationship with your builders and contractors to put that in place.
So here's a question that I have. I think, and I understand the logic behind that, right? But it seems like a very expensive way to approach projects when, it sounds like if a lot of that can be mitigated with just better management, right? So why give up that kind of equity instead of just allowing them to price in their profit up front and then managing through that process?
Well, we'll run the project both ways, and we actually find that it is more profitable for us to do it this way. Now, the amount of equity we give away would be smaller on a larger deal. The number I used of 30 to 35% was for a 4-unit condo conversion. So, that was kind of a smaller project, probably about a $500,000 development. So, depending on the project, you want to run your numbers, and it doesn't always make sense to give equity away, but in my opinion, it creates a win-win relationship. And, are there going to be times where the job works out great, the project works out great, and, at the end of the day, the contractor ends up making more than he would have made if you just paid him for his work? Yeah, that does happen. But there's also times where, the project has challenges or the market slows down. And now all of a sudden, the contractor, you're actually getting a good deal really at the end of the day. And the contractor is maybe working for a much lower rate than we would have. The most painful thing in this business is to be paying out to all your service providers and investors and everything else and not having any money left over for yourself. So by structuring these win-wins, we make sure there's money left over to profit through these deals. There's money to pay our investors properly. And, our investors kind of like the structure too, because it really forces the builder, the contractor to have to be honest and be effective and not screw around or mess up. That's important.
Yeah, awesome, man. I appreciate that. I think that's a very good perspective, right, to share. And so I appreciate you doing that.
Yeah.
So what are some of the things that you're finding in this market? And of course, how are you having to evolve now that we are where we are today?
Well, it is hard to find a deal right now, my friend, as you know. We used to do very well at the sheriff sale auctions. That's kind of been a swing and a miss for about 2 or 3 years now. We have focused more on short-term rental properties because of that a little bit. We still are buying apartment buildings. We did 3 apartment building repositions last year. We we have our eyes on the 19 unit right now. We'll probably be taken down towards the middle of this year. And but you got to be picky. You can't pay $20 for a $20 bill in this business. You got to make your money when you buy, and the only way to do that is to look at a lot of deals and kind of wait for the right deal to come around and do some off market deals, wholesales, pocket listings, direct mail marketing, all those things. And eventually you throw enough mud on the walls, you find something good, and you look at 150 bad ones to pick the right one. And really because of lack of inventory, we started doing the short-term rentals a little bit more, and we started investing in Southern Vermont, which is kind of a rural market up here. It's very different than Newark and Patterson. You're familiar with those markets in North Jersey?
Just a little bit. I don't own anything out there, so not very much, but I have a lot of, well, I can't say a lot, maybe 5, 6 people that I know that do business in those markets. One of them is a finance professor, and I give him crap all the time.
Yeah, New Jersey, North Jersey market is tough. You have rent control, you have crazy high taxes. There's a bunch of talking heads saying people are leaving the state, but I don't know, we have lines out the door to lease our units. So there's a huge amount of demand in New Jersey, especially North Jersey. So it's a good market if you know how to navigate it. And we've done very well there for many years, and we still do very well there. But it's so hard to find a deal there. So it's like, what's the best use of our time? And we need to service our investors too. We have all these investors that need deals, and if you don't bring them the right opportunities consistently, well, they're going to go looking around. So it's important that we service our investors consistently. We want to bring them an opportunity every 90 days or so. That's not always easy to do. And anyway, the short-term rentals started really taking off in 2018, 2019. Seth Martinez and I, my partner, we sat down, we looked at our business, we said, okay, well, these short-term rentals are making like 4 or 5 times the cash flow that the apartment buildings are making. Now, in 5 years, the apartment buildings are going to be worth millions more than we bought them for, so, it pays off down the road. But holy mackerel, there's nothing like a cash flow check every quarter. So we started really doubling down on those. That's about 20% of our portfolio now, and about 80% is the apartment buildings in New Jersey. But it's a nice counter to the apartment buildings because it produces strong quarterly cash flow, where North Jersey apartment buildings really don't produce a lot of cash flow. You buy them more for equity growth over time because you're kind of paying a lot to get in the market.
Sure. No, I like that strategy. So talk to us a little bit about the short-term rental strategy, right? What are you buying, where, why? What is the business plan when you're thinking through those type of acquisitions on these short-term rentals? And I understand the complement, right? The cash flow complement.
Yep.
So I appreciate you explaining that. I think that's a really great tip for our audience. But talk a little bit about the business plan and why, and the focus with these short-term rentals.
Sure. Well, up here we're buying properties. For example, I just bought a duplex down the street here from where I live in Southern Vermont. We focus on Okemo Valley, near Okemo Ski Resort, which was recently purchased by Vail Resorts, which is a large conglomerate that buys ski resorts throughout the world. So when Vail buys a resort, they put a lot of money into it, and the resort improves and the home values improve around it. And I've been coming up here for years to ski. I actually used to be a ski instructor. When I graduated from college, I lived in Steamboat Springs, Colorado for 6 months and taught kids how to ski. Read Rich Dad, Poor Dad, figured out what I want to do with my life. Great experience.
Awesome.
And so, I love to ski, and have you ever gone skiing yourself?
Snowboarding with my family and I, yeah.
And you probably spent an arm and a leg, right?
Actually, yeah, it's not very, it's
a high-end sport. Yeah.
It is. Now that I think about it, right, if you own, you're right, you have to buy. If you go out there and rent equipment, it is fairly expensive. So yeah, you're right. Yeah.
So, there's a certain demographic that likes to go skiing and vacation at ski resorts, and they're not afraid to spend a little money for the night and have a nice place to stay. And so with Airbnb, right, this new technology that's come out in the last few years and really perfected itself now. I have my qualms with it, but overall it's a good service. And there's other sites too, but that's our main site. You can now run a hotel, if you know how to do it the right way. You have to service your guests. You have to have the right product, the right asset. You have to decorate the right way, give the whistles and bells and the amenities that people are looking for when they go on vacation. And you have to be ready to deal with all the shenanigans of short-term leasing. They expect more than a long-term tenant, better service and everything. But if you can handle all that and you have your infrastructure in place like we do, then our nightly rates, I'm leasing a studio apartment in rural Vermont right now for $2,500 a month for the next 5 months to a traveling nurse who gets a stipend for where she stays. A studio, that's like a New York City price for a studio apartment, and I'm here in rural Vermont. So, if you have the right product, you have the right branding, and you know where to buy as well, you do very well with these properties with nightly rates and just produce really good cash flow over time.
And so what do you think has to go behind the positioning, right, to be able to command a premium like that? Because traveling nurse, rural Vermont, okay, there's other product there that you're competing against, including motels, hotels, right, that have more amenities, full service, right? And then, of course, you have a product now that you have to probably tell a little bit better story, right? How do you position a product like that to be able to capture that type of premium? Now, granted, I understand that the market has to be willing to pay for that, but there is some positioning as well that takes place. So can you talk about that a little bit?
Sure. Well, first of all, Okemo Valley is an area that many people travel to. It's 4 hours from New York City. It's 2 hours from Boston. I wouldn't just buy in the middle of nowhere. I wouldn't buy in an area that people aren't desiring to go to. You want to buy near, Lake George or something might be good, right? So that's the first thing. You want to buy in a market where hundreds of thousands of people are visiting every year and pay a lot of money to do that. Secondly, I think that hotels and motels are a kind of a dying breed. I think people want, at least my demographic, our younger kind of demographic is looking for a house or a kind of, you kind of want to go. It's more fun to stay at a house or something like that, or even in a two-family, than it is to stay at a Days Inn or something, or Motel 6. Secondly, if you want to come to Okemo Ski Resort, here's your options. You can stay at a dumpy motel that is really gross and charges you like $40 a night, but they're like hardly open, and that's actually being converted into employee housing. You can spend $500 a night to be on the mountain, but then you're just getting nailed on your nightly rate. Or you can be 45 minutes away and go to a cheap hotel and stay at a cheap hotel. See, so I kind of figured I come up here all the time and I'm paying to stay up here. There's a gap of somewhat affordable stays here at a house or a condo. We are buying a 7-unit suite kind of hotel place right now, but we're going to make it into higher end suites so that, that there's still, I think, room there to lease in this market. But for the most part, we get a lot of groups that love the area, the lands. We have a property on 11 acres with private hiking trails, that you can rent for $299 a night. And we just had a sauna put in, an outdoor panoramic sauna, and so we like to give those cool amenities and things like that. But it is challenging sometimes in off season with larger properties. We do struggle sometimes through off season, but peak season generally, makes up for that very nicely.
How easy is it to systematize the Airbnb business? Because I get mixed conversations, right, from different people. And I have a CPA that has spent a lot of time in this business, and he's built out some incredible systems, right? And I mean, he's perfected how they do business. He's a great operator, and he's systematized the heck out of everything. Pretty impressive. But what are your thoughts on that?
I feel like quality, you kind of, we've tried the software systems that automatically respond. And we do work with, my wife owns the short-term rental management company that manages our short-term properties. So she's really the specialist with that. But that's been one of our challenges for sure, because we want to give really good communication, really good service and fast responses. And you have like some technology going or something that responds automatically. It's not always going to be the right answer. Then you can also have virtual assistants that work for you. That's probably a smarter avenue, that you kind of have a boilerplate list of responses that people can give and things like that. And they know how to do the calendars. And so like any business, it's very technical, to really have a good quality service, good quality communication that people are looking for. You probably need a virtual assistant when you get to that point. The automatic response technologies don't really work, in my opinion, for the level of service we're looking to offer. So like any, it's definitely harder than managing apartment buildings. It's a lot easier to sign someone up for a 1-year lease and get a security deposit. And, they kind of call you when the dishwasher stops working. That's about it, And so, that's easier for sure. But we get 2 or 3 times that rate here. So you work for it too,
Okay, so let's contrast that now. Okay, with apartment buildings, I think that'll be a really good, a really good learning there, or a really good education. Just kind of contrasting some of the advantages, right, and disadvantages. So, where would you like to start with that? What stands out?
Well, I think apartment buildings really are tried and true. At the end of the day, I guess I lean a little bit more towards apartment buildings, because just having so many units under one roof is really nice. And people are always going to need a place to stay. Vacation rentals, kind of, they have their booms and busts, but for the most part, we were doing very well with it even before the pandemic. And during the pandemic, it boomed. But apartment buildings, I mean, I like them. They make cash flow. People want to live in them all the time.
I agree.
You have like 20 units under one roof. Like, you got to be pretty dumb to kind of screw it up. But, like, for the most part, they're somewhat forgiving. If the boiler breaks, well, your rent roll is $35,000 a month. So you should be able to find the $5,000 to fix the boiler. Where if you have like a 2-family or something, that can be kind of hard to cover those costs. So, at the end of the day, it's funny. I was talking to my friend the other day, and he's like, so what would you do if you had bought this cryptocurrency we were talking about, and you had $10 million right now in the cryptocurrency? I was like, you know what I would do? I'd probably sell the crypto and buy apartment buildings, because at the end of the day, I mean, crypto is cool and everything. All these other asset classes are great. They boom and they bust. But like apartment buildings, man, people are always going to need a place to live. They always are, and I get it. Bitcoin went up 6,000%. That's cool. My apartment buildings didn't go up 6,000% last year, but they make money, and they're going up little by little, and people want to live in them every single day.
I like that, man. I like that. They didn't go up 6,000, but they did make money. I agree with that.
And the year before that,
what a roller coaster ride that is, right? I mean, a very volatile product like Bitcoin.
Yeah.
I mean, it's great to be able to ride these big waves up, but man, I can't tell you over the last probably 5 years how many conversations I've been in, when that roller coaster is swinging in both directions, right? I mean, the conversations are very different. But we're humans and we have short-term memories, right? We only want to talk about the amazing.
Yeah. And it's really all about stability at the end of the day. I mean, you definitely want to roll the dice and fool around with different assets. And I to those guys that did well in crypto, my hat's off to them. But, at the end of the day, if you really think about it, it's about security, putting your capital somewhere that's secure. If you talk to like multi-millionaires, right? And they're all about really security, and really just having a place that they know their capital is going to keep growing, keep earning. And if you tell them 6,000%, they're going to be scared, honestly, right? And that's a crazy number. It's not sustainable. So it's, it's all about security, right? Yeah.
Hey, so I'm going to pivot a little bit. Okay. I'm going to pivot a little bit, Aaron. And I'm going to touch on a couple things here that one of the questions that I asked was talk a little bit about your top 3 strengths. And one of the top was, or the top is fundraising. So that's a topic that always draws a lot of attention in this business because, capital is the number one requirement. Well, I can't say the number one requirement, but you definitely need capital, right? You need capital to grow. You need capital to buy, for sure. Yep. So fundraising, let's talk about that. Okay. So when you started your business, the way that you're probably raising capital and funding your projects, probably very different than you do that today. So, what's the biggest thing that you've learned about raising money and getting transactions closed with that money?
Sure. Well, it's funny the way I raise money is definitely more professional now than I did when I first started in this business a decade ago, but it's definitely more effective. But it's almost the same. It's a relationship business. And the funny thing is some of those investors I knew 10 years ago are still investing with me today, and I've probably made them 6 figures by now. So it's just all relationship. It's having integrity. It's under-promising, over-delivering year after year, quarter after quarter. It's being honest when things are challenging and, maybe not going exactly as planned, and explaining exactly how you're going to get out of this challenge and how you're going to grow from the setback and in the investment. And also, you do have to kind of have a gift of the gab. It's a sales job at the end of the day. You got to get people excited about what you're doing. You have to have passion about what you're doing. It has to show through a Zoom webinar, and you got to get people's attention too, with the borderline of being clickbaity or whatever, right? And not breaking SEC regulation, 25% return. You got to watch how you say, but, you got to kind of do all those things. It is hard to raise capital. It's the pinnacle of my career for sure.
So if there are 3 things that you could share that you feel could help our audience, right? Those, whether they're seasoned operators or folks looking to get into this business about raising money, what would those 3 things be?
Well, first of all, if you're just getting started and you are raising capital, and friends and family is where everyone starts. The truth is, if you meet someone over the internet on LinkedIn or something, they're really not going to give you their hard-earned capital if this is your first deal. So friends and family is where you need to start, and that can, but that can also be done with just networking groups and going and building your infrastructure and having your good boots on the ground, your builders, your contractors, whoever you're working with, your realtors. So lining up your whole systems in place and building those relationships. And what I did was I actually started a real estate networking group. So the way I started raising capital was I went on meetup.com, and I think for $39, I started a meetup group in about 2010. And I've always enjoyed public speaking. You put me in front of the room and give me a couple cliff notes and I'll just, go for it. And so I enjoy public speaking. And my first presentation was called Fake It Till You Make It. I had been doing short sales, and I spoke at a really big group, NJRESN, and another meetup group, okay? And this guy knew how to pack the room, right? And those guys are always looking for speakers, especially if you're kind of engaging. So I went up to him and I said, hey, man, can I speak at your event? I'm a new realtor in this business. I have 14 listings already. I focus on short sales, and I'm going to be a house flipper one day. I'm going to be a real estate investor one day, and I'm going to talk about how I fake it till I make it. He said, yeah, man, come on. And so he gave me the floor. The next month, I did my presentation, and I raised some capital. I raised about $50,000. I paid an 18% interest rate. That's how I got started. But it was from complete strangers in the room. And, then the second thing I did was I knocked it out of the park with my first few deals. Not that we knocked it out of the park. I think we just hit our targets, but we just really did everything we possibly could to make sure that, and listen, things went wrong. The first deals you do are probably the sketchiest and the toughest. Now they really move a lot better. We really, just learned through the years. So, and those first few deals were tough, but we definitely really did well with them. We really made sure we hit our marks. If we didn't, we still wrote a check to make sure our investors made that target, no matter what the deal actually made. And, we always did that. We always made sure our investors got paid and didn't lose money. And most of our deals were quite successful and quite lucrative, which helped us then build our marketing and our branding even more and get more deals. But it took years, and you can't go to someone and raise 50 grand and bring in another deal a month later. You got to cycle that deal, and then they'll look to invest again. So it's a big process. It took me many years to get to the point where I can raise $1 million in 60 days or so, which isn't even that impressive in the grand scheme of things. But for one guy and a virtual assistant, it's not bad,
Awesome, man. I really appreciate you sharing that. That's been, I think, some really valuable nuggets in there. Well, hey, but we are at the end of our show. I want to thank you, Aaron, for being on. This has been a great conversation. Many nuggets that you've placed inside of this conversation. I love the fact that when you came on, you talked about short-term rentals and you created a compare and contrast of apartment buildings. And ultimately, it sounds like apartment buildings still are the preferred method of generating long-term cash flow. However, I do see the value in short-term rentals, especially if you're buying in high demand market areas, right, where you can get a premium for rents as a great offset. And if you have cheap debt, I think it's a no-brainer. I've done that as well, by the way, last year. I just, I saw some great opportunities. Yeah. Financing was really cheap, right? 2.5% money. I mean, I don't know if I'm ever going to see that again. Still very cheap money. And, consequently, I thought it made a lot of sense. So I ended up buying a couple of properties for that reason. And they perform really well for us now. And, it makes sense. I don't want to be in that business long. All right. So you touched on a couple of points there about the compare and contrasting of apartment buildings. I think that's great. And then we moved into, financing. You also shared a couple of things about your partners and your partnerships, right? And just some of the experiences that you've had and why partners or good partners are so important. And I think above all else, that one of the things that really stands out is just time in this business, right? Mm-hmm. It is not an easy business, nor is any business for that matter, but our willingness to be able to focus on doing the right things, staying in this long term creates ultimately, I think that those are some key things that contribute to success. And I think that's reflective in your comments of saying that, you have a pretty good following of investors at this point, and I think those qualities kind of speak to your following, so love the show, man. Thanks for being on. Really appreciate you sharing your insights and your wisdom. And I want to wish you continued success. What is the one question that you have of me, Aaron, that you think can add some value to our audience, since I've been asking you questions for a good 40 minutes?
Sure. Well, I guess that was a great question you asked me. What was one of the biggest lessons you've learned or the biggest lesson you learned in this business? That was a kind of hard one to answer. How would you answer that?
Well, I'm always learning. So every year I learn something new. And of course that changes. That question, the way that I'm going to respond to that will change. But at this point, I think the biggest one, at least as it relates to where we are today, is a couple of things. Number one, you just have to be consistent. Consistency would be one. And I think resiliency kind of plays into that. But number one, just being consistent. Yeah. The little things usually creates really big outcomes. Two would be the importance of building and training really good people. So building really good teams and training, right? So systems would fall into that as well. So when I say building good teams, not huge teams, but small teams of very well trained people with really good process.
Effective teams.
Yeah, very effective teams, high performing teams. And I've had to learn over the years that process is a really big component of that. There are times where I've hired really good people, had really poor process. People weren't doing that great. And I've learned that it's either people or process, and usually people are willing. And, I was the one who was failing in being really clear with my process, right? So those are two things that really stand out. If I had to point to a third, especially in this market, is the importance of communicating on a consistent basis with your capital sources, whether it be debt or equity, because when the markets change, on the debt side of the equation, it's really important to understand who's doing what and why and how they're looking at the markets, because that usually will help us figure out how we need to pivot in our business to be able to, capture the opportunity that the market is going to be offering up based on the changes in the economy, right? Yeah. And so those have been really big things. And of course, on the equity side of the equation, just maintaining communication with investors and keeping them engaged, right? I think that will always be a requirement, but those would be my top three.
Yeah, communication is so important. I've talked with investors that have invested with other syndicates much larger than ours, and they don't communicate all that well, or when they do, it's kind of just not clear. It's like kind of just legal mumbo jumbo, and people appreciate a real honest, consistent communication, and that's what it's all about.
Yeah, man. People just want a direct answer, right?
Yeah, right. The worst is when you ask someone something, a salesperson or something, they give you this roundabout answer. So you're like, I immediately.
Most of the time, a lot of those questions can be answered with just a straight yes or no.
Yeah, exactly.
Just a straight yes or no, and the truth of the matter is, people appreciate that, right? I mean, one of the changes that I had to make is really making sure that when I'm onboarding an investor, for one, that they resonate with our message. And I've learned that if I can do that, and when we do that, I think our opportunity to align better with that person is better, and it's just an easier relationship, right? And we just have a lot more success together. And that was a really, really big one for me. But anyways, to your point of just being able to communicate directly with people, I mean, everybody appreciates that.
Oh yeah, it's all about communication and knowing your stuff. It helps to have some experience in this business and know your ropes.
Yeah. And here's the other side of this too, though, right? I mean, there are times where we're not going to have all the answers all the time.
Yeah.
But it's okay to say that. I mean, it's okay to say that. I think as long as you're performing and you have a track record of performance, you bump into a wall. It's okay to say, hey, look, I bumped into this wall, but here's how we intend on either going through it, going over it, right? Going around it.
Yeah.
And, people just appreciate that. So, hey, bud, I want to thank you for being on. What is the best way for people to get in touch with you, Aaron? What is the best way for them to find you out there?
Sure. So our website is peoplescapitalgroup.com. That's our company, People's Capital Group. So I also have a podcast called the Passive Cash Flow Podcast. So I have to have you on it.
Sure.
And it's a great podcast. You can check that out at peoplescapitalgroup.com, where we have our offerings. We have other properties for sale for investors. And we also have an application form. You can start the qualification process and get qualified to be on our investor list and start looking at our private offerings as they're available.
Sounds great, man. Hey, thanks so much, bud, for being on. I want to thank you again for being a great guest. I want to wish you continued success, and we'll talk soon.
Thanks, John. Good day.
Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.